The stock market is currently closed for the weekend, so as of the market close on Friday, July 24th, 2026 at 4 p.m. Eastern Time, Nokia OYJ stock traded at exactly $9.10 per share on the New York Stock Exchange. That represents a single-day decline of 6.47% or 63 cents per share on an extraordinarily massive trading volume exceeding 119 million shares. While a sharp red session like that usually sends casual retail traders running for the exits, the story unfolding beneath the surface tells a completely different story than what a quick glance at the ticker would suggest. Most casual market observers still view Nokia through a very limited lens. They think of it as either a faded mobile phone brand from decades past or a slow-moving, low-margin telecom equipment vendor trapped in the unpredictable spending cycles of traditional wireless carriers. The prevailing market narrative says that if you want exposure to massive digital infrastructure growth, you buy high-flying mega-cap tech companies, while legacy European network suppliers like Nokia are destined to offer stagnant top-line growth and sluggish stock performance. That expectation, however, is colliding head-on with a new fundamental reality. While traditional mobile network upgrades from major mobile carriers have indeed experienced a cyclical slowdown, Nokia has been aggressively shifting its revenue base toward high-capacity optical networking, specialized IP routing, and enterprise data center infrastructure. The modern artificial intelligence cluster requires an unprecedented amount of bandwidth, low latency, and energy-efficient optical interconnects. Hyperscalers and cloud giants are now knocking on Nokia's door to build out the high-speed backbone that links massive server farms together. That shift creates a stark contrast between what Wall Street expects from traditional telecom vendors and what Nokia is actually delivering in the cloud hardware space. To understand why the stock pulled back to $9.10 despite this underlying momentum, you have to examine the immediate trading action surrounding its latest second-quarter financial results. In the most recent reporting period, Nokia delivered a net income performance that surprised analysts on the bottom line, reporting adjusted earnings per share of 7 euro cents against Wall Street consensus estimates of 6 euro cents. However, net consolidated revenues came in at 4.82 billion euros, barely missing the 4.83 billion euro expectations. In a market environment where momentum investors demand flawless double-digit beats across both top and bottom lines, even a minor top-line miss can trigger immediate profit-taking. That earnings reaction explains why trading volume exploded to over 119 million shares in Friday's session, well above its multi-month average. Short-term traders using popular consumer trading platforms like the Robinhood app or executing trades through active accounts on SoFi Invest reacted instantly to the revenue headline. Yet while retail sentiment temporarily turned sour, major institutional desks were quietly taking the opposite side of the trade. Institutional analysts at J.P. Morgan recently reiterated their overweight rating on Nokia stock with a price target of $21 per share, specifically pointing to expanding order backlogs in artificial intelligence networking and cloud infrastructure. Similarly, researchers at Argus Research upgraded the stock to a buy rating with a $15 price target. When you compare retail investor behavior across individual brokerage platforms with institutional positioning, a clear divide emerges. Individual investors engaging in self-investing through a Robinhood stock trading account or managing their own Robinhood investments often focus on daily price swings and quarterly top-line headlines. Meanwhile, institutional wealth managers using platforms like Fidelity Brokerage, Fidelity Wealth Management, or Interactive Brokers Trading are looking at longer-term structural shifts in capital expenditure. When telecom carriers slow down their 5G build-outs, retail investors assume the entire business model is broken. Institutional money, on the other hand, sees that non-telecom enterprise sales and optical routing orders for data centers are growing fast enough to offset legacy weakness over time. If you examine how investors allocate capital across popular self-investing channels today, the contrast becomes even more obvious. Millions of everyday market participants log into their accounts on Robinhood Cash Management or browse options on various investing sites to buy well-known names like Tesla stock, Apple stock, or Nvidia stock. There's nothing wrong with holding core mega-cap tech companies, but focusing solely on the most popular ticker symbols means many traders overlook foundational infrastructure plays trading at a fraction of those valuation multiples. While high-growth semiconductor giants trade at steep price-to-earnings ratios, Nokia trades at a discounted valuation relative to its long-term free cash flow potential. Take a moment right now to leave a comment below. Comment below how many shares of Nokia stock you currently hold in your portfolio, or share your thoughts on whether you think data center network upgrades will drive telecom stocks higher over the next year. To evaluate whether this valuation gap represents a true buying opportunity, it helps to review Nokia's operational structure and history. Headquartered in Espoo, Finland, Nokia organized its business into 4 primary operational segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies. The Network Infrastructure Division handles fixed networks, optical networks, and IP routing hardware. This is the branch currently seeing accelerating interest from cloud providers and utility operators. The Mobile Network segment supplies radio access network hardware and software to global wireless carriers. Cloud and network services build software platforms for core network management and enterprise private wireless networks. Finally, Nokia Technologies manages the company's vast global patent portfolio, generating high-margin licensing income from smartphone manufacturers, automotive companies, and consumer electronics brands. Historically, Nokia's profitability was tied almost entirely to the capital expenditure budgets of major mobile operators. When wireless carriers were building out 4G and early 5G networks, equipment providers enjoyed strong order flows. But once those coverage build-outs matured, carriers naturally reduced their spending to preserve cash flow. That cyclical drag created years of choppy earnings performance, leading many investors using automated services like Schwab Intelligent Portfolios or a SoFi robo-advisor to underweight the legacy communications equipment sector in favor of pure-play software or semiconductor stocks. However, the reality of global digital infrastructure has evolved dramatically over the past 2 years. Modern artificial intelligence applications require massive computing power, but computing power alone is useless if server racks cannot transmit huge volumes of data without latency bottlenecks. That is precisely where Nokia's optical networking equipment and high-performance routing silicon enter the equation. By acquiring specialized optical networking firms and expanding its proprietary chipsets, Nokia has repositioned itself as a key supplier for high-density data center interconnects. This diversification creates a stabilizing counterweight against traditional carrier spending cycles. Looking ahead at future outlook scenarios, the central tension between expectation and reality will determine where Nokia stock trades over the coming quarters. The conservative market expectation assumes that Nokia's revenue growth will remain sluggish due to ongoing caution from Tier 1 telecom operators. If telecom spending remains depressed for longer than anticipated, top-line quarterly growth could remain modest, keeping short-term traders skeptical. Furthermore, competition in optical routing and private wireless remains fierce, requiring continuous research and development expenditure that can temporarily compress operating margins. The bullish reality, however, rests on 2 key catalysts. First, as cloud hyperscalers accelerate their capital spending on next-generation computing facilities, the demand for optical routing and high-capacity network switches is projected to expand significantly. If Nokia continues to capture market share in enterprise network infrastructure, higher-margin enterprise revenues will represent a larger percentage of total company sales, expanding gross margins. Second, the stable cash flow generated by Nokia Technologies' patent licensing provides a reliable floor for self-funded share buybacks and dividend payments, offering downside support for patient investors. For investors managing their portfolios through an individual brokerage, an interactive broker's account, or retirement vehicles like Fidelity IRAs, understanding these structural dynamics is essential. Whether you use the Fidelity mobile app, execute trades through an interactive broker's platform, or prefer SoFi active investing, success in self-investing requires looking beyond surface-level stock polls. While short-term sentiment knocked Nokia stock down to $9.10 following its Q2 revenue miss, the underlying enterprise trajectory shows a firm positioning itself at the center of global cloud connectivity. In summary, the expectation that Nokia is merely a struggling legacy telecom supplier does not match the reality of its